Hello, everybody. Welcome back to Strongman Personal Finance. My name is Christopher Belly. I'm a certified CPA accountant. I'm a long-term Boglehead investor. I'm author of the book Stop Being a Broke Loser. It's on Amazon. And we're going to review the portfolio of none other than the world famous 160-something thousand subscriber YouTuber known as ticker symbol U. Now, this guy is a massive fanboy of Cathie Wood. And even worse, he's a ginger. I'm just kidding. I got nothing against gingers, but apparently there's like a whole thing. Gingers get made fun of. Whatever. You know, you can have some hot redheads sometimes. Women, of course. So anyway, we're going to review his portfolio. And I'm not going to judge it based on the red. Because he has a lot of red in his portfolio. Like an ungodly amount of red. Like he got freaking wrecked. Because he was one of the guys that when the whole pandemic started, all he did was talk about Cathie Wood in the future and blah, 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 blah. So we're going to see what happens when you invest based on hype and speculation, okay? So let me go ahead and share my screen. And we're going to check out this guy's portfolio, my Olio. Now, okay, he's got 162,000 subscribers. Now, this may be a little bit blurry, but here you can see his, I think this is his main retirement account. And he currently has Ark X, Innovation ETF, Teledoc, Ark G, Threed Capital Registered SH. What is that? Ark W, Palantir, Wejo, C, and something else. So let's go one by one and check this out. So Ark X is down 64%, Teledoc down 78%, Ark G down 63%. IDOF, whatever that is, down 48%, 42, 48, 44, and 17. That's a pretty brutal year. Now, anybody's portfolio can have this kind of fluctuation. I don't see it as being very probable for something like VT because it's the global index. If it fell by 78%, we are in a major, major recession or like some nuclear bomb went off or something. But holy crap, this guy has not had a good year. So, well, first, let's go look at Ark X. Let me give you my thoughts about that. So here we are on the Ark website. Ark my shark! And they have multiple ETFs. So Ark X. Wait, is that Ark X? It's kind of blurry. Yeah, I think it's Ark X. Let's go check it out. So Ark X is the Space Exploration and Innovation ETF. I've actually reviewed this ETF, and I was not a fan. So let's see what it is. It's an actively managed ETF that seeks long-term growth, blah, 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 in the theme of space exploration and innovation. Now, remember when I did analysis on this? The whole space industry wasn't going to grow that quickly. I was not impressed with the potential of the space industry. And, of course, there's a lot going on with the space industry. I mean, there's a lot of problems to overcome. It all depends on government budgets and stuff like that. So it's an interesting ETF. But we'll see some of the holdings in there, and then I'll give you my thoughts. And of course, the number one thing that I always look for is annual fees, 0.75%. That is 10 times more expensive than the VT ETF. 10 times more expensive. That will significantly reduce your returns in the long run, 0.75. That's freaking crazy, okay? Now, you can speculate, and maybe this ETF will freaking 10x at one point. I doubt it, but that's a crazy fee to pay, okay? So let's go look at the holdings. So the largest holding is Trimble. So let's prop in Trimble here. Trimble my bimble. Trimble my bimble. The Trimble, oh, it's up 5% today, or the last time the market was open. So initial analysis of Trimble is, okay, they have some revenue by revenue growth. Let's look at the profitability. Net income. They are actually profitable. That is pretty shocking for a Cathie Wood ETF. They even have free cash flow. 54% gross margins, 15% operating margins, 12 to 15% profit margin. So right off the bat, this is a company I would consider looking at. It doesn't mean I'm going to buy it because it's profitable, but at least they have some profits. Share change, they're really not issuing shares. I mean, they issued what, 1 million shares in 2021? Not that bad. I wonder if they've done earnings recently. Okay, so they just released earnings. They had 12% revenue growth. Okay, that's good. And are they still profitable? Profit went down a little bit. but yeah, 11% profit. So this is a company that I could value. I could potentially value this company. Let's look at the statement of cash flows. So cash from operations. So it looks like it's been pretty steady over the last couple of quarters. 153 million, 155, 166, 200, 228. And it looks like it's been slowly declining, well, significantly declining year over year, but that could be a fluke. And then we go look at, let's see, financing cash flow. So it looks like they're actually purchasing shares back. That's interesting. Look at that. They spent $107 million on buying shares back. Let's go back and look at the income statement with the quarterly. Let's see if their shares drop pretty significantly. Okay, that's odd. They didn't drop. So that's something you'd have to research more. But it looks like they spent $107 million buying back shares. That's a pretty significant amount of money. Okay, capital expenditures. So it looks like they're pretty steady, you know, 10 million, 14 million, 14 million. Okay, let's look at the balance sheet. So they got cash and cash equivalents of $357 million, receivables of $655 million. So they roughly have $1 billion in liquid assets. Now, I don't like to count inventory and other current assets because inventory is not as liquid as you might think. When you're assessing a company's solvency, you want to be as strict as possible. So we'll say they have $1 billion of current assets, and they currently have 1.7 or $1.2 billion of current liabilities. So their acid test ratio is actually not that great. However, the vast majority of their current liabilities is deferred revenue. Deferred revenue is you've been paid cash, but you have not earned the revenue yet. So looking at this, their accounts payable is only $213 million. And their liquid assets, current assets, are $1 billion. So honestly, I don't see them going out of business anytime soon, especially with such a large account balance in deferred revenue. That's not that bad. And they have some other current liabilities. So even then, their quick ratio is over 1. Now, they have long-term debt of $1.2 billion, $1.4 billion. And it's been pretty steady. So they're not going into massive debt. And they really don't need to unless they're going to buy a bunch of fixed assets. And they don't need to finance their operation because they actually have positive operating cash flow. So looking at this company, I mean, it's okay. I mean, you'd have to do more research, but whatever. And it's 10% of the portfolio, whatever. Kratos Defense and Security, Kratos. Kratos, my tomatoes. Kratos. Kratos, my tomato. All right, so we got, basically flat revenues over the last, 7 quarters. Let's see if they're profitable. Profit margin. Negative, 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 and increasing. Free cash flow margin. Negative, 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 and increasing. What else? Shares outstanding. Relatively flat. Let's look at cash flows. Let's see. Operating cash flow fluctuates. Positive, negative, negative. Okay. Capital expenditures. Wow, they had a pretty big acquisition pretty recently. $58 million. Okay. Let's say. So overall, this is not as an impressive of a company. I mean, maybe there's a reason their free cash flow is negative. They're probably they could be investing a lot into, buying businesses and stuff like that. But at the end of the day, this is a not very interesting company to me. I would not consider buying this because just right off the bat, I don't like it. The next thing, they have a freaking 3D printer ETF inside of another ETF. So they just went ahead and bought another ETF. Why? Okay. So overall, it looks like some of these companies are profitable or at least close to profitability. Deere and Co., Blade. Okay. Maybe there's some potential with this ETF. Maybe. But the problem is he bought it during a speculative mania and he basically bought the top. He's down 64%. All right. Next, let's look at Teledoc, my big throbbing you-know-what. Teledoc. Teledoc, my cock. Teledoc. Let me make sure I'm sharing my screen. Okay. Teledoc. So we've already talked about Teledoc. They had a massive, massive loss recently because of a impairment charge. They had a massive balance in goodwill. That's when you buy a company for more than the fair value of its net assets. And then they discovered you have to do an impairment test. They basically discovered that the future undiscounted cash flows of the company are less than the book value, and then they had to write it down to fair value. A bunch of accounting jargon. What that means is they massively overpaid for this business. So if we look at their income statement, you can see this massive charge. Where is it? Where's the charge? Other operating expenses. You can see, oh my God, look at that. So they had like these tiny little operating expenses, and then they had this massive freaking charge. So that freaking wrecked the stock. Now, if we take out the impairment charge, they would still, would they be unprofitable? They would probably just barely be breaking even if we took out the impairment charge. So they're still not profitable. And we can go look, and we can see, okay, profit margin. Okay, just ignore that. That's a freaking disaster. But one thing that interested me about Teledoc was you could see they had terrible profit margin, right? And then it got better, and then it got better, and then it got better, and oh my God, it got better. And they were almost profitable. And then they had this massive impairment. So when they bought Livongo, they totally screwed up. They massively overpaid. So that's a problem with management right there. But there is some potential with this company. Am I buying this yet? No, but I'm interested because you see they have a high gross margin. That's good. Shares, they are issuing shares, but it's not crazy. 159, 160, 161. What else? Let's look at the cash flow. Cash flow by ash flow. So operating cash flow. Positive, positive, positive. And they had 1 quarter of negative cash flow. Okay, interesting. Let's look at free cash flow. Where is it? Down here. Positive, 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 massive negative. And what caused the free cash flow to go down? Capital expenditure. So they had negative operating cash flow. Then they had 30 million of capital expenditure. So that's what caused the free cash flow to be significantly negative. But there is potential in this company. I'm not going to deny that. I'm not buying it yet, but I think what he did, he bought it way too early. It's all about timing. You don't want to buy a company after it's massively run up just because the financials are improving and blah, 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 blah. You actually have to do fundamental analysis and say, am I paying a good price? Because what happened is he's down 78%. 78%. That is an almost unrecoverable loss. But now, if you're looking at Teledoc now, after it's massively sold off, you can see the financials are improving, and you buy it now, your downside risk is a lot lower. I'm not saying buy it, but holy crap. Ark G. Ark G, my PP. Ark G, my PP. Let's see. Ark Genomics. Now, Genomics, and I don't like these kind of companies, these biotech companies, because a lot of them are highly speculative. And a lot of them are, they don't even have revenue. Like, it's crazy. Now, with the Genomics, they're super volatile. You know, you may buy in and it shoots up and you get freaking lucky. But at the end of the day, they're super hard to value unless they're like really established. Let's see what holdings they have. Exact Sciences. Exact my nutsack. Let's see. 9% of the portfolio. Income. Okay, so they have revenue. That's good. Their revenue is growing. They have, oh, God. Let's see. What is their... Oh my God. Negative 40% profit. Negative 36%. Negative 46%. Negative 37%. Free cash flow. Negative, 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 increasing. Holy crap. Oh, God. Let's look at their balance sheet, my balance sheet. Okay, so they have $816 million of liquid assets. Short-term investments, you can sell those pretty quickly. And we'll see what they have in current liabilities. $480 million. So they're not going out of business within a year. That's great. They also have a massive amount of goodwill. Like, that's a lot of goodwill. Goodwill, like I said, you pay more for a business than it's worth. God. So their total assets are $6.4 million, $6.4 billion. And their goodwill is $4.4 billion. So a lot of this company's book value is the intangible asset. So a huge risk with this company is just like freaking Teledoc, where they had that massive impairment charge. It's the same thing here. They could have a massive impairment charge because they bought a business that's not worth what they thought it was worth. And you could have a massive, massive, massive decrease in the total amount of assets. I mean, I don't know. I wouldn't touch this freaking company. Holy crap. Let's see. Debt growth year over year. Okay, it looks like, are they issuing a lot of long-term debt? Okay, they issued about $300 million of debt in the quarter ended 12/31. And I wonder what they bought. Did they buy anything with it? Okay, they bought some PP&E, but not enough. And they might have used that debt to buy some property, plant, equipment, and some other long-term assets, but they didn't. They must have spent the debt somewhere else as well. Let's see the cash flow. Operating cash flow. It fluctuates a lot, but the last couple quarters, negative, and they had a massive decrease in operating cash flow. So they're burning cash from their operations, at least over the last couple of quarters. Let's see, acquisitions. This is where the goodwill comes from. You can see they spent $427 million here, $368 million, $105 million, $102 million. They're buying companies hand over freaking fist in this company. And with negative operating cash flows, the only way they're going to finance this is they're going to have to issue more shares or go into debt. So I would be careful, okay? This company is not something I would touch. It's very, very unprofitable. And it's 9% of the portfolio. Ions my Trions. Let's see. Revenue, my Avenue growth. Holy, what is going on here? So, looking at the different quarters, 160 million, 290 million, 111 million, 125, 133, 440, 141. Let's look at the annual. Okay, this company's revenue is all over the freaking place. I don't know if they're like super contract heavy dependent, but holy freaking crap. This company would be very hard to value on, or to place a revenue growth number on based on the face value assessment, because it's just all over the freaking place. Let's see, shares outstanding, not really issuing many shares. Gross margin, holy freaking crap, 99%, 97%. Maybe they just don't even have cost of goods sold. I mean, just because they have a high gross margin doesn't automatically make it a good buy. Operating margin, all over the place, but basically negative. Negative 58, negative 64, positive 50%. Okay. It's probably an accounting thing. Negative 40. So this company's losing money hand over fist too. Look at the free cash flow. Let's go look at the balance sheet, and we'll look at the cash flow. Okay, so they have about $2 billion of cash equivalents, and short-term investments. That's pretty liquid. And they have, okay, yeah, they ain't going out of business anytime soon. I can tell you that. I mean, their biggest liability is deferred revenue. So basically, companies paid them in advance. They just haven't done the work yet. So when it comes to, solvency, they're not going to have any issues. All right, long-term debt. Let's see if debt's increasing. Other long-term liabilities. So long-term debt has exploded over the last couple of years. They had 623 million, and a couple quarters later, 124 million. So they're issuing debt. Let's see, cash flow, my /slow. All right, let's go down. Operating cash flow. Wild fluctuations here. Wild fluctuations. Negative 54, negative 62, negative 55, 203 positive, 31. I don't like this company. I don't know how. This is very speculative, and it's all over the place. You'd have to do a lot of research to understand a company like this. And of course, it's 9.2%. Then they have Teledoc. We know what happened to that. I think I've seen Vertex before. I think that was more profitable, but it's only 4% of the portfolio. So once again, this genius bought this during the height of the speculative mania, and now he's down 63%. Ark W. Actually, I want to see what this IHOF 3 Capital. I can't even read it. Let me see if I can put it in. I don't know what that is. IHOF. Freed. No. Freed. No. Maybe it's a SPAC. Very odd. I know. I don't know every stock in the stock market. I'm an idiot. Weejow. Now, I saw videos of him talking about Weejow. Let's see what Weejow, my schleeschlau, is. Weejow. Ouija board. Weejow. Excuse me. I'm so stupid. All right, let's look at the revenue by What is this? Okay, this is their quarter. Okay, this is weird. So they had, okay, they had quarterly revenue, and then they randomly have 6 months of revenue, which is nothing. And then they made $350,000. I know people that make more than that from their income. And then they got $1.3 million for the 3 months ended 12/31/2021. So what is this? They're barely making any revenue by revenue. This looks like it's highly speculative. Okay, massive share change. I don't know if they just went public or something. Let's see. Profit margin. Oh my God. Negative 7,307%. Negative 4,000%. Wow. Whatever this crap is, this is insanely speculative. Cash and cash equivalents. Okay, let's just be nice and say they have $131 million of liquid assets. And then they have $36 million of current liabilities. Okay, so they're not going out of business in either anytime soon, but I bet you they're burning cash like freaking crazy. Let's go look. Oh God. So they burned $76 million of cash in 3 months. The last 3 months they released financials. So if you go back and look at their balance sheet, if they keep that cash burn, so what is it, 76 divided by 3, they're burning roughly $25 million of cash every single month. So they roughly have 4 months of cash reserves before they completely go bankrupt. So I would be surprised if they issued shares. Actually, they probably already did issue. It's already May 15th. Jesus, what is this? This is garbage. This is freaking trash. Why would you buy this? And here he is. How much is he down here? 44%. Okay. Holy crap. Oh, I know what Palantir is. Well, look at this last one, C Limited, SE. SE, my PP. SE. Okay. Income, my schlum. Okay. They have pretty massive revenue by revenue growth. That's good. Let's see. Let's look at some ratios. Gross profit, 3640, 3740. Okay. Operating profit, negative. Profit margin, negative. Shares outstanding. They've been issuing shares at a pretty hefty clip. Let's see. Over 1 quarter, they issued, let's see. 554 divided by 539. So they diluted you by 3% in 3 months. So, you compound that out, it's probably like 12, 13, 14% a year. That's pretty freaking bad. Balance sheet, my balance sheet. They got $13 billion of short-term or liquid cash reserves. And they have, current liability, $7 billion. So, okay. And a lot of that's deferred revenue. So, okay. I mean, they're not going out of business within a year. I can tell you that. What is this? What's wrong with their statement of cash flows? The freaking statement of cash flows doesn't even work. Look at this market cap. Okay. You see how it massively exploded? Their market cap was 124. Is that billion? Holy crap. And then they massively crashed down to $42 billion. Oh my God. Wow. So overall, this guy's portfolio is hot freaking trash. And just look at the decimation. Now, short-term fluctuations mean nothing, but I hope you learned looking through some of these businesses, the vast majority of them are highly speculative. Their income fluctuates quarter over quarter. Most of them are massively unprofitable and issuing shares to stay afloat. I don't get it there, ticker symbol U. You need to come on here and explain this to me. I don't understand, bro. All right, let's look at some comments. There's so many freaking comments. Oh, my God. Put a shirt on. No. It's my YouTube channel. I know who you are, by the way. Why don't you like Ark G? Humans are literally made of genes. I never thought about that. 10 subs from 6K. Let's go pump it up. Tell your mom to subscribe. Tell your grandma to subscribe. Strongman, space isn't the future. I mean, at some point it might be, but man, Cole's analysis is just out of this freaking world. Earth is 100% of the universe's market cap. The Earth is massively overvalued. Oh man, this guy's got jokes. I like. Go subscribe to his channel. He's pretty funny. All right, let's see. We are all clowns in the grand scheme of things. That's very deep and philosophical there. They're both white. What? I want you to fight Lafufu and meet Kevin. Oh, when my channel gets big enough, I'm 100%. I don't know if you guys saw the Graham Stephan versus that other guy, boxing match. Me and Lafufu are going to have a boxing match one day. I think people would pay big money to watch that. Like, if that organization wants to make money, all they have to do is bring me and Lafufu in there, and people will just throw money at that. I would get a cut, of course, after I stomp Lafufu into the dirt. Let's see. I've been saying Cathie Wood is dumb for years. Yeah, it's not hard. She just buys speculative trash. Let's see. SPTM. What is that? 60% is nothing. Biotech can drop. I would stay far away from biotechs. I'm 100% serious. Biotechs scare the crap out of me. They are all over the place. And a lot of those companies are pre-revenue. They're not even making money at all. Like, top line money. They're freaking bad. I would not touch that Ark G crap. Admit defeat. Me and Amit are debating tomorrow at 9 p.m. Eastern. And it's happened. We had to reschedule because he didn't have time. He wanted to debate me at like 11 p.m. I was like, dude, I'm freaking tired. I'm not going to debate that late. Your channel is growing fast and you can catch up. Yeah, I'm hitting the videos hard, man. I can see this I can see this channel finally getting momentum after all this time. Finally, you clowns are freaking subscribing. So anyway, everybody, tell your friends to subscribe. I need 6K subscribers now. And don't buy any of these trash stocks that Mr. Ticker Symbol bought. And y'all have a wonderful day. Cheers.